Okay, there we go. Good, Barry. Hey, everybody, welcome to the Market Structure Edge live demo and discussion for, what is it, October 19th already? Wow, it's hard to believe. I'm Tim Quast, and I'm joined by Brian Wilson, who will, you should be taking the first half of this, Brian, but he doesn't want to, so okay, I will. Sergio, thank you for joining. Yes, please, go ahead. If you've got yeah, you might have to unmute yourself, Sergio. Where are you? Here, I'll unmute you. Did I lose you, Sergio? If you've got a question, go for it. Or just put it in the no sound. You might have to jump out and come back in. See if that does the trick. Okay, and oops, there. Now you can hear me. Okay. So I hope I won't forget something from the market desk notes this week, but I want to talk about, I've got 4 things. What we mean by stocks that are diverging from their central tendencies, when during the day to buy and sell. I'll tell you what I think about that. I promised to talk a little bit about shorting. I only short the market with ETFs. I don't short individual stocks, and it's because I trade in an IRA. But Brian knows a fair amount about that, and he'll cover that a little bit too. And then I want to talk. One of you sent me a fairly detailed note and said, "Hey, what do you think about this strategy?" Where I look at sectors and I look for the top stocks in those sectors, and I'll highlight what this person is doing. Look, I haven't studied that data, but it's a decent idea. And so I'm going to share that. Then hopefully I can do that in efficient fashion, and then hand you off for the good stuff to Brian. Okay, and at any time, interrupt me, and we can talk. We can answer questions. Okay, so let me share my screen, and we'll talk about this first one. Bear with me 1 second here. Okay. Okay, there we go. So when we talk about a central tendency, really kind of a monetary policy term or a statistical term, but what we mean is the prevailing observable bias in the data, or to put it in simple English, what we expect to occur. So if stocks are departing from what we expect to occur, there's probably opportunity. It's not always true, but for instance, if what we see in the broad market is rising demand and falling supply, and the market isn't following that at some point during the day, well, there may be an opportunity to go long the market. I did it today when the market was down. I bought SPXL and sold it. And it's because I could look at the central tendency knowing that it's being affected by options expirations. If you're new, we pay very careful attention to what we call the cadence and the calendar of the marketplace. You have Jay Powell talking today. You have derivative instruments resetting. That's options expirations. Those things can alter outcomes. But if all other things being equal, ceteris paribus, as the lawyers like to say, you would say, well, their demand continues to rise, and we're looking at the green part of the graph, and this is SPY, and it's been very volatile. That's to be expected around options expirations, the beginning of earnings season. Those things are going to distort outcomes. But I'd look at that and say the central tendency should be an opportunity to make gains yet. And the supply side was beginning to change. But this dip below the trend line, we had high short volume here, 51%, came down to just below 50%, starting to tick back up. I don't know what's going to happen. But I'd say, well, the central tendency could change pretty soon. And there's options expired. VIX options expired yesterday. We're right in the middle of those. But the point is, if stocks don't do, or the market doesn't do what the math generally indicates, which thing will be right? Well, things tend to mean return to the central tendency. The market is highly mathematical, and so those create opportunities. And I've mentioned this before. I'll give you one example. Now, I was glad to be this worked out. So it could have been disastrous, but the probability was that it would not be. I went into today owning this stock VRT because it dropped sharply yesterday. And of course, the data that I'm using was right there. October 17th would say it's a 10 with falling supply. Well, the probability is that there's opportunity to produce a gain, some part of the stock's volatility. And of course, it was down more than all of its volatility yesterday. So I bought it late in the day. And I want to show it to you in a portfolio so I can point out volatility. And I'll make sure that I think it's in industrials, isn't it? Isn't that right, Barry Norton? I believe it is. Let's see. Let's see if I'm right. Oops, that's not it. Am I wrong? Is it? No, there it is. It is an industrial. Okay, Brian, I don't know, it's not somebody knocking. Can you address that? Okay, so the jumped up. The 5-day average is almost 6%. Well, it's down more than that yesterday. So I would look at that and say, well, there's a good opportunity. If I look at the market, the central tendency is still up. Volatility it's consumed all of it. So there's a very high probability of getting some portion of that back. Well, before the market opened, it was up very nicely. Then as the market opened, got going, it plunged again. It's not fun. And I had removed my stops because I don't want it to move through those. When you put in a limit order of any kind, it moves into a pipeline that could be sold and that can be seen. Somebody's going to know that those things exist there. I find that if they're narrow, oftentimes I get taken through them. That's a whole separate discussion, and maybe I can cover it in point number 2 a little bit. These won't take too long. But knowing the central tendency, and maybe it was divine intervention, I bought more of it. So I could have cut my losses, but I bought more of it because it was not behaving the way that the math indicated. Now we know that looking again at the stock, that it's time to be out of it. This is the great thing about a signal like this. Demand's falling. It's still, it can move from 10 to 9. The supply side's fine, but these are the conditions that tell you to probably go unless it's in a long-term portfolio where you stay in things that are at 5 or better. And when they drop below 5, then you're out. For a short-term trading strategy, I want to go move on to something else. And that all worked out. So the price returned and gave me a very, very nice gain beyond my entry point. But again, if I had looked at the price, would I have known? No, I looked at the supply-demand equation and the central tendency of what that will produce, and it worked out. Don't gamble, but I felt pretty good about the probability that the stock would not continue to fall, that it would probably rise. But once it did, I left. And it was, it took I owned a lot of it, like 1,000 shares of it. And so it took a bit for me to get out of it. But it's an important lesson about that's what we mean when the central tendency is pulling in your favor and something doesn't follow it. Oftentimes, those are opportunities. So questions, comments, observations on that? If not, I'll hit point number 2. Keep it moving.
Tim, there's a separate question from Joseph in the chat.
Okay, thank you very much. Okay, thank you, Joseph. So I have multiple IRAs. In this particular IRA, it is a trading account, and I trade about $50,000. I try to trade that, no, I've got it. I've used interactive brokers. So when I'm not in the market, I'm earning a nice return on the cash. It's a 4.83%, something like that. Works out well. Produces the return overnight every day. But when demand is rising and supply is falling, I tend to be as fully in the market as I can be. When those things reverse, I might short. And I can talk about that in point number 3. But no, I'm trading it, and very actively so. I mean, I probably traded 40 times this morning. Okay, so when do you? when do you get now in and out? I'm not, I will qualify this by saying we studied this math, and there is very little statistical difference between the average price and, believe it or not, half buying something down half its volatility. I like to do the latter. Buy something down half its volatility because there's a very good chance, knowing how machines set prices. Machines move the market down, the machines move markets up. That's not rational behavior. Those are the machines that set the prices, and you saw it all day today. Down, up, down, up. Who's doing that? Well, machines consume words and they move the market. It's not human beings saying, oh, Jay Powell said this. No, wait, that's, dovish. No, wait, it's hawkish. It's machines that look at how prices are changing. That's what it is. And John Cook, I know you're pretty good at this, that if the market's down 1%, what's the probability that you can get some of that back? Because the broad market SPY has about 1.2% intraday volatility. The underlying stocks are about double that. There's a great arbitrage opportunity for machines to change prices. Believe it or not, if you do a volume study of SPY, what you will conclude is 96% of the volume is a form of arbitrage. That's what it is. It's the differences in price. We've done that. We look at the create redeem data underlying SPY and compare it to volumes and inflows and outflows, and you net all that and you find out, wow, all of it is it above or below the basket? So that's how the market works. And when there are central tendencies that you can observe, like supply and demand, there are opportunities. So when the market was down today, and John, you may have done this too, I thought, well, it's very likely to rise. So I bought SPXL, 3 times levered S&P 500 ETF. And I made a good solid 1.5% on that. Then I left it. Now that's not something I do it because I know what's occurring. So when you look at when do you buy or sell, beware that in the first hour, there's a lot of high frequency trading furnishing liquidity. I talked to one yesterday from Virtu, and he said, he's showing me this data about where they supply liquidity, and it happens a lot. So if something moves on me in the first hour, I'm going to wait, because it's very likely that is being influenced by machines that will change direction. This doesn't have to shape how you trade. There is a point. If you're trading much larger sums, you can probably using an algorithm that gives you volume weighted average price, some derivation of average price, is very effective, because statistically you are as likely or even more likely to get a good return from a supply demand divergence than if you buy something like I did, VRT down all of its volatility. Now that worked out, but mathematically there's not that much difference. Look at how much VRT moved around today. It was down to 37.5 or less, and up over to 39.5 and back down. It's all over the place. The market is tremendously unstable because trade sizes are very small and most of the prices are set by machines. Half of my trades today were 20 shares, even though that's not what I'm putting in the market. So it's very, very fragmented, and that's why prices change. So when do you do things? The point is, mathematically, prices are going to move all over the place, and you will know what the central tendency is by the overall supply-demand balance. And you say, well, why wouldn't the market finish up today? Well, look at big tech. Remember, as Mark Rowan, the Apollo Global CEO, said, we are all leveraged to 5 growth stocks and the Federal Reserve. So once big tech stops rising and supply begins to increase, even though it's still fairly low, the market's going to struggle, particularly during options expirations. And you're going to know that ahead of time. That doesn't, it doesn't tell us everything about the market, but it's an important thing to be aware of. Okay, comments on that? I mean, I'm not sure I gave you an absolute clear answer. The important point is the market moves in sort of predictable fashion because of the machines that set prices. They do stuff early in the day, they do stuff late in the day. Average prices are probably as good as statistically anything else of getting you a good return. I still like to buy things that are down a good portion of their volatility. I prefer it. Statistically, I cannot support that it's a better approach. I tend to like it. Maybe it's my, value propensity. Okay.
Tim, quick question from Sam there in the chat.
So Sam, to answer the question, and in case you can't see it, so Sam's saying, does Edge consider SPY short volume from other instruments like open interest in futures, options, etc., or just the stock volume? Well, what we're seeing in SPY is that stock's volume. But I think the whole market is affected by the tremendous use of leveraged derivatives instruments like SPXL. SPXL doesn't own anything but a basket of futures, and they're going to revamp those every day. So it's a derivative based on derivatives. So, and I think those things then increase the overall presence of high short volume in the market. And you can see it everywhere. Look at airlines and cruise ships. Terrible thing to be in, by the way. That, you know, they're too volatile for a lot of passive investors. Very high levels of supply there. So indirectly, Sam, we're going to see those effects. Directly, we're going to measure it by instrument because that's what FINRA requires. Okay, last, and Brian, I want to leave you plenty of time here. So let me just briefly, and you're going to do this longer. So I get a lot of questions about shorting. So how can you use Edge to short? Well, I'm going to give you a really quick example. Barry Norton has done a fair amount of work on this. And Barry, I'm going to basically follow your model, which is let's create the inverse of the momentum portfolio. So I'm going to look for market structure demand that is, I'm going to say less or equal to 9 because it's going to be falling. And I want the trend in demand to be down, equal to down. And I want the supply side to be the opposite. I'm going to say I want the short volume, this right here, supply to be greater or equal to, I want to get it above 50. So I'm going to say 55, could be a higher number. And I want the supply, I'm going to use this one, the 5-day trend, because I want it to be a near-term event, is equal to up. So what we're doing is we're looking things that have rising supply and falling demand, right? That's really what we're after. And let's put a volume factor in here just to increase our safety net. So let's say greater or equal to, I'm going to say 500,000 shares, but you could pick any number. So as long as it's liquid. So there we have a screen, and we can filter this for stocks that will probably have a propensity to decline. We end up with 35 stocks. Then you could narrow this by, say, let's certainly sort it by demand, and let's let me think about this. Maybe we want higher price stocks. I don't know. There's an idea. Not too high. You could adjust market cap, maybe drag that up so we've got we're assured of having ones that are fairly large. That gives us 21. It's just an idea, and if you want to take a snapshot of this, feel free. I think that's right. 1, 2, 3, 4. Yeah, that's close enough. And then you can just check the data. Do these things have a propensity to decline? Well, we'll find out, but yeah, it's breaking down. You'd have to go through and look at each of these during the day. But what mathematically, the probability that rising supply and falling demand will lower the price is very high. So it's a way to go about it and increase the probability that you have things that show all of the mathematics of a central tendency to the downside. Now realize it's best if the whole thing's moving that direction. Is the sector that it's in doing that? Is the broad market showing falling demand, rising supply? You get all those things pulling the same direction, the probability you can produce returns is much, much higher. Okay, so I chewed up a fair amount of time.
Tim, can I just one comment on top of that?
Please,
I find if you're going to use the reverse of momentum, the opposite, and I'm a little bit higher. I go 1 million shares, and I like a little bit higher liquidity. But that said, typically I need to have demand at a 9 or an 8 coming off of 10.
Okay.
If it's below 5, then it's not really as good. It's got to be, the demand's got to be higher coming down, and then I find those work better.
Okay, thank you for that. There you go. There's the the veteran's sage perspective. Okay.
And Tim, one question about demand in the chat room for you.
Okay. How's demand estimated? Okay, so Madhu, if I haven't pronounced your name correctly, apologies. What we do is we run a calculation based on the rules that govern the way that trades are handled and executed in the stock market. There are a whole set of rules under what's called Regulation National Market System that govern it. And all the things in the national market system have to be handled the same way. They have to meet best execution standards. They have to report how those trades are routed around the marketplace. So that gives us the capability to look at behaviors. You know, is there money trying to be at the reference price? Is there money racing through changing the price? We call that fast trading. Is it hanging out in one place trying to get a lot of a particular stock? Tends to be active value investment. Is there a counterparty associated with wholesale derivatives liquidity? Well, if we can see those things, that's risk management. We can put those together with average price and measure almost like a market cap weighted index whether demand is rising or falling. And again, prices must trade between the bid and the offer, which can never be the same. And over, call it 85 to 90%, maybe it's a little higher now, it keeps inching up, of orders are derivations of midpoint because everybody's trying to get in there. I can use 50 different algorithms at Interactive Brokers to get me to the midpoint because that's where the regulators want the prices. So out of that, guess what we can do? We can normalize to a 10-point scale what direction demand is going. It's a very good tool for understanding what's occurring. And that's what demand is. It's the mechanics of the market that's measuring how buying and selling wax and wane. And it does a very good job of telling us. I mean, if you looked here at this, if for CFLT, when demand returned to 5, if supply stayed right at trend, overall the price trended up a little bit. Once demand began to deteriorate and supply began to rise, price declined. It's not perfect, but the correlation between those features is very high. That's what we do. Okay, Brian, over to you. I'll stop sharing.
Thank you, Tim. Good to see everyone today. We appreciate you jumping on the meeting. Just a couple things to share with you. One, we hear occasionally from clients, can you, share specifically why you're doing certain things? And Tim certainly did that here during the first part of the meeting. I did want to share a trade that I did this morning, and it actually goes back to the big tech setup, very similar. So big tech, where demand is now trending down, short volume moving higher. I have a similar portfolio set up for the FANG portfolios. Demand moving lower, short volume starting to move higher as well. What I did this morning is I shorted the FANGs, and I just did that through an ETF. This one is actually at 3 times levered to the downside. I prefer 2 times, but I could not find one. These types of trades where you're coming off of a 10, they're a little riskier because demand could get restored again. I could lose money on that trade. I decided to take a chance. I'm up 3 or 4% on that so far today. But the reason that I placed the trade, once again, demand starting to move lower, supply starting to move higher. That's why I went into a short trade on FANGs this morning. I wanted to move over for a second and talk about what we see occasionally during options expirations, and we're seeing an uptick in volatility. I wrote about it this morning. What you're looking at here on the screen is the S&P 500. This is a 3-month chart. I wanted to take you back to where we were at options expirations last month. The reason for that is there can sometimes be displacements during expirations. So this was the first day of expirations right here. We had tremendous upside. It actually happened to be, I remember we were talking about the upside that particular day. And Tim and I had mentioned that we were going to go short the market after the meeting got over. And you can see what happened the next day, market went down. Part of this was a displacement at expirations. And once again, we wrote about it this morning. you don't know everything going on in terms of dealer books, counterparty activity. We can't see what's on their books. So some of the activity during expirations will be a mystery. But Tim mentioned that, there are central tendencies that we can see, and take a peek at what we were looking at during last month's expiration cycle. So this is it right here, S&P 500 up top here. Here's that move higher during the middle of expirations. Well, notice what was happening in the market. Sentiment was starting to fade. We were coming off a sentiment top. Look how high short volumes were. Now, there's no way you can ever guarantee anything in the market, but that was a pretty good setup. Does it take courage, to short into a move like that? Sure. It could have gone higher the next day. I could have lost money. Tim could have lost money. I might have had to move in with Tim. I'm not sure. But it worked out. And part of the reason is that the central tendencies, were in our favor. What does it look like right now? It's a little tougher, right? This was a much better setup to short the market. If you move this back year to date, and I had shared this with you at least in one previous meeting, maybe twice. This setup right here from a short volume perspective still, to me, closely resembles what was happening in March. We basically traded sideways on the SPY for the better part of a month. If you look at where we moved through, this green bar is an indicator of oversold conditions in the market. And we got some upside coming off of those oversold conditions. But notice what's happened. Short volumes have been high during the entirety of that move. Look at where the SPY was when we came through. It was basically 429. Where were we yesterday? 430. Once again, those sideways conditions in a high short volume environment. It doesn't mean that you can't move higher for a period of time, but it does make it difficult to hold on to gains. I'll share one other item with you. I think I have time to do this. And it's not something that we have on Edge, but we'll basically share the dynamics with you if we see it kind of affecting the setup. And this is actually from John Cook. It's an idea that he provided for us. What you're looking at is just a pivot table, looking each day at stocks that have bottomed in the market, down, topped, and then moving higher. And I look at this information every day. So the takeaway here, if something's happening in the background that you should be aware of, we will definitely let you know. Look at the setup here, 1012, 1013, 1016. We had demand really moving higher across the market. At one point, 46, 47% of the companies were moving up. What's that going to do in the market? Well, you're probably going to have some upside. There was that S&P 500 return a couple of days ago. Well, what happened 2 days ago? Well, that demand started to shift. We started to move from companies moving higher to additional companies that were topping, and that shifted even more today, where now the number of companies that have topped, well, that's the greatest in the whole market. It tells me that unless the data changes the next couple of days, our central tendency probably points lower from here. Now, I could be wrong about that. You look at that demand trend right now, that's a pretty healthy demand trend, and maybe that continues to move higher, and maybe short volumes move lower, and all is well with the world, and we move into next week and everything's great. But right now, in my estimation, I would say that the central tendency points lower. That is my take, and like I said, I might be moving in with Tim.
Got plenty of room. That was my best trading day since June. That short, yeah, it was a very nice return. Like 4 or 5% on my portfolio, and I'm after just 2 at any given time. So questions, let's see, Alex, let's see, each of the past 3 days, the S&P, NASDAQ declined, yet demand sentiment continues to rise. Right. So Alex, to me, this is the challenge of options expirations. I liken it to black holes in space. The only way we can see a black hole is because they bend light. So you can't observe them, but you can observe the effect that they have. And so it's like we can't see, half of the derivatives market is over the counter. It's non-standard, it's not exchange traded. And so we can get some read of the derivatives central tendency from what's displayed, but there's a lot that isn't. And when you're stepping into when these things renew, you never know what you're going to get. Generally, when you have diverging supply and demand and the market doesn't react to it, at some point you're going to have an update, which we did this week. We had a very strong, and that's to be expected. But the cause of the diminished reliability of the data, so to speak, is because of derivatives. To me, it's options expirations. Then you can throw in the effects of earnings season. Earnings season is 10% of the S&P 500 reported results this week, and people make directional bets. Those alter outcomes, and it's why I say it's a more challenging time to trade. And if you have a weak stomach, we'll just wait till you're on the other side. You don't have to take chances during those periods. But that's my answer. I don't know. If anybody else can add to that, if you have a differing opinion. But I'm
Tim, yeah, I mean, yeah.
Don,
so
yep.
OPEX is occurring.
Yep.
You can see the market structure of options. There are other services. I won't hawk them on your call, but I combine your data with theirs. And today we were very put dominated. So basically the way the dealers were set up, if the market, there's a lot of the in the money and out of the money puts above the market. So that pushed the effect down. Obviously Paul had some, he moved things around a little bit too, but he sounded pretty hawkish. So him hawkish into, what Brian just showed you, which was declining demand, I think. And then, the way that the options market was set up, I'm not surprised we're down another 1% today.
Yep. I traded SPXU today too. I traded SPX. I'm not encouraging that behavior, mind you, but because you need to be very comfortable with what you're doing and being very careful. I don't take chances with those things, but I did. I traded SPXL up, and when the market started to recede, I traded SPXU down because I know what the machines are doing, and I know where options expirations clearly has turned big tech, and the probability I could get a little something on each side was pretty good, so I did. But it's you want to practice that first. The reason that we're confident doing those things, though, is because we can have a pretty good view of the data. We can see what the sectors are doing. What direction is supply and demand going? Is it still going into big tech? Nope, it's not. You could look at Tesla before Tesla reported results and say, that's not going to work out very well. You could see it. The demand was deteriorating. So those things give one confidence, not perfect protection. If I'm trading those leveraged instruments, I don't take chances with those. I will put in. I'm happy to get limited out with a little bit of loss if I need to. I can always come back to them, but you just have to beware that they can be dangerous instruments.
Yeah, I think, Tim, I mean, to your point, to me, big tech was the tell. It took us up, and now I was, because of the demand state and where broad sentiment was, bullish Monday and Tuesday. But you could see, I think it was Tuesday or Wednesday coming in, like it had shifted, and IWM was down, right? The Qs started going down, and the S&P like gets pulled in between those two. And so when big tech flips, I mean, 25-30% of market cap is rolling down. You see this happening on top of OPEX.
Yep. Well said. Dan, I cannot trade your account, alas. But that reminds me. So Dan and I have been trading some notes about this. We're running these back test scenarios, and I'm pretty comfortable with the engine that we've got. We ran some very good data. By the way, that model said today that it would buy MRO and UNH. But I've ran a year's worth of the data, keeping it small because I want to go back and manually validate these data. I've got an engineer who has built the code. Math is pretty reliable, but it doesn't mean we might have missed something in there. So I don't want to broadcast this and say, well, this works absolutely, but I can find the portfolio it could only have 5 stocks at a time with a set of entry criteria, 2 exit criteria, falling demand or supply over 55%. That's it. And ran a year's worth of data with that portfolio. I was up 140%. So now that it seems so crazy that I don't at all trust that. It doesn't seem possible. So I want to go vet the data. But if we can find that works, this is my answer, Dan, to your point. We would put that on edge. You could put that on in a portfolio. Here's the long-term portfolio, not the short-term. This is something that you stay in until it says, okay, change those out and replace them with this. It's a longer term approach. If it works, clearly there's great merit to that, but I need to validate it fully before we would make that generally available. Okay, we've chewed up, I think, all of our time. Any concluding comments, thoughts, words of wisdom? I need all the words of wisdom I can get. Okay, all right. Thank you all. Good to see everybody. We'll do it again next week. See you then. James, you were quiet. I'm hoping for that British accent to be displayed for all.
Things have moved on because I used to just shout things out, and now it seems to be very organised and professional. So I'm just sitting. But no, nice to be back in the saddle.
Well, it's good to see you. Yeah, we've tried to clean up our act and be civilized in this affair now.
No, it's a lot smoother.
Well, good to see you. Thank you, everybody.
And you.
Have a good
Cheers.
weekend. See ya.